Greetings traders, and welcome back to another survival guide. Chris here as always, bringing you some more information. In today's discussion, we'll be covering the VWAP. This is known as the volume weighted average price. It is an indicator, so those of you that like the technical analysis-based discussions that we have, well, you're in for a treat. This is something that, when understood and mastered correctly, can be exactly what you need to pass the Gauntlet Mini. It provides an in-depth view of what's going on in the market and can give you some insight that may not be visible when you're just looking at plain charts in comparison. But before we go any further, let's talk about how we can apply the VWAP to the charts. That way you can follow along during the entire discussion. If we're using the Finamark platform, we're simply going to go to the top center portion of the screen, where we're going to click on this Show Indicators Options button. Now, because the VWAP does overlay the candlesticks themselves, it will be in the center icon here, or the center column, I should say. And as we scroll down, you'll see VWAP down here, second to bottom. If we give that a click, it will apply it to the charts. And when we return to the charts, we will see that there is now a line running through price. That is our VWAP. Now, without any further ado, let's go ahead and get started so we can learn more about the VWAP. A rather large mistake that traders sometimes make in the beginning of their trading career is analyzing an instrument's average price based only on its closing value. But for traders and long-term investors who want to get a more clear picture of the health of whatever it is that they are analyzing, they became aware that there's a lot more to it than that, and that's why they began looking for a tool that would allow them to help identify a traded instrument's actual average price by taking trading volume into account. Hence, the volume-weighted average price was born, and this is considered to be one of the best instruments for a fair representation of the traded instrument's quality. So let's talk about exactly what the volume-weighted average price is, otherwise known as the VWAP. Well, as we saw, it is a trading indicator that we can apply to our charts, but this indicator considers both volume and pricing information to come up with a complete representation of the average price a security has traded at throughout the entire trading session that is being measured. The volume-weighted average price serves as a benchmark for market participants looking to get a clear and detailed picture of particular investments that they're looking to make or a trading opportunity that they're looking to become involved with. The VWAP stands out because it reflects the stock's real average price based on the volume of transactions instead of just the closing numbers. The VWAP is also essential because it gives the market participants insights about the trend and the value of the traded security that they're analyzing. Due to all of this, it has become a very prevalent tool for everyone involved in buying and selling financial instruments today, and it's quite commonly used. Today, day traders, speculators, and large-scale investors like pension funds and mutual funds all are known to use the VWAP from time to time. On a chart, the VWAP is usually displayed as a moving average, but is much slower than a typical 8 or 20 period moving average. The calculation for the VWAP is relatively simple. The VWAP is equal to price times volume over volume. There is another more academic version of this equation that you can find online if you so choose, but we're not going to cover it here because I feel it just unnecessarily makes it look scarier and more complicated, and ultimately we won't really ever have to actually do this math. This is just being displayed so we have an idea of where these values are coming from, because after all, in the end, both of the formulas that are used to calculate the VWAP do the same exact thing. They take the number of shares bought and multiply it by the share price. Then the number is divided by the total shares bought. The result is the value for the VWAP. It represents the asset's average price based on the number of shares or whatever it is that we are measuring. Maybe it's contracts, if it's shares, if we're talking about stocks. It measures it traded at different prices throughout the trading session. The time frame the calculation is made for is usually a single day or what we can consider a period. Nowadays, traders rarely, if ever, just calculate it by hand, so once again, don't stress the math so much. This is just, once again, and to keep you in the loop with where these numbers are actually coming from. So how can the VWAP help us as traders? Well, the short answer is by giving us a more accurate representation of the traded instrument's actual price. Market participants who consider only the instrument's closing price usually fail to acknowledge the role that volume plays in the process. As a result, they may fail to realize the effect that this has on the general trend. For example, did the stock hit a new low with low trading volume, or did it close at a high with low volume? The additional context the VWAP provides allows the trader to make more informed decisions and better project the strength of the traded instrument's trend and health. Day traders and speculators use the VWAP to evaluate how good the momentum is for buying and selling. They generally will build strategies around the VWAP and often employ it as a confirmation tool, but mostly for trades that last from a few minutes to no more than a couple hours. The most popular scenario is going long when the price range is above the VWAP and going short when it is ranging below it. Day traders also have a rule of thumb that protects their positions from whipsaw effects in price, and this rule usually is around the concept that if the VWAP line is flat but price has made a quick up or down move, the most likely scenario will revert to the VWAP line, meaning price will be likely to revert to the VWAP line. On the other hand, if the VWAP line is getting steeper along with the trend, counter-trend positions usually aren't advisable in this scenario. Large-scale investors and more passive market participants like pension funds and mutual funds use the indicator to predict better when to move into or out of a trade with as little market impact as possible. Alternatively, they'll use it to avoid affecting the market for the particular instrument. To do that, large-scale investors usually sell above the VWAP and buy below it. That way, the price is pushed to its average rather than away from it. The most widely spread and easiest way to use the VWAP is quite similar to the interpretation that most traders have of general moving averages. Prices ranging above the VWAP line are usually reflecting bullish sentiment, while those below the line indicate bearish sentiment. So here on this chart, we can see a green line working its way through price. This is the VWAP line. In the red box, we have a scenario over here on the left where we had bearish sentiment triggered by the VWAP showing price falling below it. Price fell below the VWAP line and we saw bearish activity thereafter. And on the right hand side of the screen, we have a green box right here that indicates when price began working its way above the VWAP line and trading above it, and bullish momentum thereafter was followed. Obviously, we don't simply want to buy and sell blindly just because price is above or below the VWAP, but the VWAP in conjunction with price action can be a very, very powerful tool and provide a further layer of confirmation as to whether or not we should even be interested in buying or selling in the first place. The VWAP is a very good representation when it's provided a large sample size of data at showing us what in the world is actually going and where is price actually heading. Is it a serious downturn in the market? Is it a serious upturn in the market? Or is it running directly through the middle of the line and we're seeing a more range-bound period or period of some type of consolidation or period prior to some type of distribution? But when we work our way below substantially or work our way above substantially, the read provided by the VWAP is generally a very solid one. When we take a look at a chart that has a VWAP, which is our green line here, and a blue line, which is going to be a simple moving average, it starts to become a little bit more apparent that these two are not the same thing. The VWAP indicator improves upon the conventional moving average like the simple moving average by factoring the trading volume into the price to provide the market participants that are using the VWAP with a better and more complete benchmark. Its calculations are based only on new information, which is relevant for the current market session, and it doesn't consider past data that could be outdated. Now, if you prefer having that past data in there, then a simple moving average might be more your speed. They are both valuable tools for traders, but ultimately it's important to understand how they differ. That way you can decide which is best suited for your particular trading style and your particular trading strategy. When plotted on a chart for the untrained eye, the volume-weighted average price might not look extremely different at first. We can see that the green line and the blue line are relatively similar in the trajectory that they're going, But aside from this, the indicator is providing a much different read than the blue line, which is our SMA. The difference between the two can be described as how they're calculating. And if we look at the VWAP, it's summing up the prices multiplied by the volume and then divided by the total volume, where the simple moving average is just going to be the sum of the closing prices divided by the number of trading periods. So once again, that VWAP is factoring the volume in, whereas the blue line is not paying attention to volume at all. The VWAP is helping us reduce market impact, so is very popular with the big institutional investors, whereas the simple moving average is not doing anything to that effect, and it really can't help reduce the impact. With the VWAP, once it starts measuring, it starts fresh. With the simple moving average, unfortunately, it is going to start with all past data. Our VWAP is really good at helping us identify short-term trend reflection, whereas the simple moving average might be the better tool to analyze that long-term trend because it includes all of that past data. The VWAP is known to have a quick response to the current trends because of its nature, whereas the simple moving average usually is going to respond a little bit slower. The key takeaway is that the VWAP is not going to be undisputably better than the SMA overall, it's that it's just simply different. One is an apple, one is an orange. They both measure information in the market and provide it in a digestible manner for us as traders, but ultimately we have to decide how and when to use that information based on the current market activities as well as what our particular trading strategies are. Another common question that traders using the VWAP have is how does it differ from other volume-weighted things like the volume-weighted moving average, for example, instead of the volume-weighted average price? They do sound very similar. Well, the volume-weighted moving average is a moving average that considers the trading activity for the given time frame to emphasize the effect of volume on prices. The volume-weighted moving average puts more weight on prices with high trading activity, but on the other hand, prices surrounded by less trading volume usually receive lower weight by the volume-weighted moving average. The lower weight is beneficial sometimes because it helps identify stable trends and reliable momentum opportunities. Although the volume-weighted moving average is a more complete indicator than a simple moving average, both are close in the value during periods of low market volume. That means the volume-weighted moving average will look quite similar to a simple moving average during those periods where there's not a whole lot going on. We can use the volume-weighted moving average for several purposes, including discovering emerging trends, confirming existing ones, or identifying upcoming market reversals. And this is precisely one of the core things that makes it different than the VWAP, which is our volume-weighted average price. There are many other differences between both indicators, starting with the fact that the VWMA, the volume-weighted moving average, is an updated moving average, and traders often use it in addition to an SMA. In a nutshell, the VWAP is a cumulative of the average price in relation to volume. Its calculation begins at the start of each trading session, and it doesn't drop any data over time. Instead of the bar's close, it uses the typical price as in the sum of the low, close, and high prices divided by 3. On the other hand, the volume-weighted moving average uses fixed periods that allow it to drop older data. Its calculation is continuous and spans across several sessions, unlike the VWAP, which is reset at the start of every period. Both of these indicators aren't mutually exclusive, just like the SMA, they're just different ways to gather that information that we're seeking from the market. If we were to talk about the advantages of the VWAP itself, one of the common things that traders will accredit it for is the fact that it's factoring in the trading volume. It also helps spot lows and highs to buy and sell. It can also signal changes in market sentiment. It can also help capture the perfect momentum to get into a trade in relation to liquidity, transaction costs, and help provide that best execution location. It's useful for retail traders and large-scale investors alike, which is another big advantage. It's a building block for many trading algorithms, and if you are using it, then you might be at the core of an algorithm giving you one step up over those who are not using it. It can also be used as a dynamic area of support and resistance, and it can help reduce the market impact of large-scale traders. As far as the disadvantages of the VWAP, it requires a vast amount of data to provide an accurate picture. It doesn't take historical data into account as we discussed. Many traders only consider it reliable as a single day indicator. It may also lead to missed opportunities and strong trends if waiting for price to drop or rise above or below the VWAP line, if not complemented with outside analysis. And when the VWAP is fed too much data, the VWAP line can experience lags throughout the trading session. It also can be not reliable if it's used on timeframes that are too long. So most traders prefer to use the VWAP on 1, 5, or 15-minute charts because once it's used on a time frame that is much larger than that, we start to see weird issues with the VWAP because of it's trying to calculate the opens and closes across multiple sessions. So, in conclusion, mastering the VWAP isn't going to come overnight, but then again, really no indicator trading strategy ever is. Using indicators to help get a better idea of what's going on in the market is providing us, at first, a new way to look at the market, which means we're not supposed to be completely comfortable or totally proficient with them right out of the gate. The VWAP provides us an opportunity to make sure that whenever we're buying or selling, that we're doing so at hopefully a fair price. It gives us an idea of where those institutional buyers and sellers might actually be placing their orders, and this can be huge, especially if you're trying to pass something like the Gauntlet Mini. But until next time, folks, good luck in your trading out there. I wish you all the best. I will see you soon. Cheers, folks.